Let me start with something real estate investors need to understand going into 2026, because this is a big shift. IRS audits are not random anymore, and if you invest in real estate, they're becoming a lot more predictable. Most people still think audits only happen when someone does something extreme: fraud, huge income, obvious red flags. But honestly, that's not what's driving audits right now. What's driving audits in 2026 are patterns. Patterns created by inconsistent reporting, messy records, and tax strategies that don't line up cleanly with reality. So in this video, I want to walk you through the real tax planning issues that are triggering audits for real estate investors in 2026. Not in a checklist way, but in the way these problems actually show up. Before we get into specific areas, let's talk about why 2026 is different, because that context matters. Why 2026 is a different audit environment. The IRS has better visibility than it ever has before. Bank data is cleaner. Reporting systems are faster. Real estate transactions leave digital footprints everywhere. That means returns that might have gone unnoticed years ago are now getting flagged automatically, not because someone complained, but because the numbers don't line up the way the system expects. And real estate creates complexity by default. Multiple properties, multiple entities, multiple states, multiple income streams. And that's where audits start. All right, with that foundation, let's move into the first area where things usually break down. Let's talk about bank deposits and income mismatches. This is one of the most common ways audits start, and most investors don't even realize it's happening. The IRS often begins by comparing your reported income to your bank deposits. If deposits are higher than income, the system flags it. And at that point, the burden shifts to you to explain why. Now, here's where real estate investors get tripped up. Not every deposit is taxable income. Loan proceeds aren't income. Refinance cash isn't income. Capital contributions and internal transfers aren't income. But if those deposits aren't clearly labeled, documented, and easy to trace, the IRS may assume they are income anyway. This is why clean banking matters so much more now than it used to. Separate accounts, clear descriptions, consistent bookkeeping. These aren't just best practices, they're protection. Now moving on, let's talk about an area investors love to use, but often don't fully plan. Moving on to depreciation and cost segregation. Depreciation is still one of the most powerful tax tools in real estate. That hasn't changed. What has changed is how closely it's being reviewed. Bonus depreciation has not phased out. In fact, it's back at a complete 100%. Cost segregation studies are under more scrutiny, and generic, cookie-cutter assumptions don't hold up the way they used to. What we're seeing in audits isn't that depreciation itself is disallowed. It's that the support behind it doesn't hold up. Accelerating depreciation without modeling income, timing, and exit strategy creates problems later, especially when the numbers don't match how the property is actually used. If you can't clearly explain your depreciation to an auditor in plain language, it stops being a benefit and starts becoming a liability. Now, let's shift gears a bit, because this next issue usually shows up as portfolios grow. Let us talk about entity structures that don't tell a clear story. As investors scale, they often add entities, LLCs for liability, separate holding companies, partnerships. None of that is wrong. The issue starts when money moves between entities without documentation, or when multiple properties run through shared bank accounts with no clear separation. The IRS doesn't care how many entities you have. They care whether the numbers make sense. If income shows up in one place, expenses in another, and ownership doesn't clearly align, the story falls apart quickly under review. Clean structures are not about complexity. They're about clarity. All right, now let's move into something that feels small, but gets flagged constantly. Now let's talk about expenses and how they're treated. Expense classification issues quietly create audit risk. Repairs versus improvements. Personal travel mixed with business travel. Meals, vehicles, and home office deductions that don't match actual use. In 2026, the IRS relies heavily on pattern recognition. If deductions look out of line for the type of property or income level, they stand out. And here's something investors don't realize. Even legitimate expenses can be denied if they're poorly documented or treated inconsistently from year to year. Consistency matters just as much as correctness. Now, moving forward, let's talk about something that catches growing investors by surprise: Moving on to multi-state tax issues. Once you invest across state lines, your tax obligations multiply. Different states have different filing requirements, different estimated tax rules, different entity registration and franchise tax expectations. Ignoring those differences doesn't eliminate the obligation, it just delays the problem. A lot of audits start when the IRS discovers that required state returns were never filed, and once that happens, prior years often come back into focus. Now, let's talk about one of the most sensitive areas in real estate tax planning. Let's talk about real estate professional status. Real estate professional status remains one of the most audited positions going into 2026. The issue isn't claiming reps. The issue is assuming qualification without support. When reps is challenged and fails, the IRS doesn't just disallow 1 year. They can unwind multiple years of losses at once. That's where the real damage happens. Now, let's shift to something that doesn't get talked about enough. Now, let's talk about inconsistent reporting. Switching strategies year to year without explanation is another quiet trigger. Changing expense treatment, reclassifying income suddenly, large swings in deductions with no clear reason. Even if each year looks reasonable on its own, inconsistency raises questions. The IRS expects logic and continuity. If the story changes, they want to know why. All right, let's pause for a second because there's a common thread here. The common thread behind most audits in 2026. Most audits in 2026 are not about fraud. They're about defensibility, clean records, clear documentation, strategies that match how you actually operate. That's what holds up under scrutiny. So what are smart investors doing differently? How investors reduce audit risk without giving up tax savings. They align banking, bookkeeping, and tax reporting so numbers match across systems. They treat depreciation and cost segregation as planning tools, not automatic moves. They clean up entity structures and document how money flows. They stay consistent year to year. And they plan before tax season, not after. Audit-proof tax planning in 2026 isn't about being conservative, and it's not about being aggressive. It's about being defensible. If you're investing in real estate and want to reduce audit risk while still maximizing legal tax savings, the work has to happen before problems show up. If you want help building a real estate tax strategy that actually holds up in 2026 and beyond, head over to gavtax.com. Thanks for watching. I'll see you in the next video.